Students, this is Diligence here, and today we're just gonna do a quick sum up. We listened to whatever J Powell said on Friday, and we sort of want to decode it. What are the underlying messages that he's saying here, and what are some of the stuff that people are missing? Or we just want to address the overall retail euphoria on Friday, and when euphoria comes, people FOMO, and it's time for us to punish.
History also teaches, however, that central banks cannot take for granted that inflation due to transitory factors will fade. The 1970s saw two periods in which there were large increases in energy and food prices, raising headline inflation for a time. But when the direct effects on headline inflation eased, core inflation continued to run persistently higher than before. One likely contributing factor was that the public had come to generally expect higher inflation, one reason why we now monitor inflation expectations so carefully. Central banks have always faced the problem of distinguishing transitory inflation spikes from more troublesome developments, and it is sometimes difficult to do so with confidence in real time. At such times, there is no substitute for a careful focus on incoming data and evolving risks. If sustained higher inflation were to become a serious concern, the FOMC would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal.
So what is J Money speaking here is, all right, in the 1970s, there was a time that, the Fed thought, the transitory period have ended, but the inflation didn't really go down. So then they have to sort of react just like before. What they do is they hike the interest rate. So here J Powell is saying, hey guys, sometimes, we might be wrong, but we have the method to sort of deal with higher inflation. And just keep in mind, guys, if the transitory period ends and then the inflation keeps going higher, and if your inflation expectation keeps going higher, all of your expectations gonna build up, and the inflation is going even higher, and then we are forced to, our hands are tied, we are forced to increase the interest rate on, more interest, sooner than ever, or sooner than we expected. This is what he's trying to say here.
Incoming data should provide more evidence that some of the supply-demand imbalances are improving, and more evidence of a continued moderation in inflation, particularly in goods and service prices that have been most affected by the pandemic. We also expect to see continued strong job creation, and we'll be learning more about the Delta variants effects. For now, I believe that policy is well positioned. As always, we are prepared to adjust policy as appropriate to achieve our goals. That brings me to a concluding word on the path ahead for monetary policy. The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address.
So that period of the previous paragraph that he was saying is, hey guys, right now, as of August, we're not really gonna change anything in terms of monetary policy. The interest rate is gonna stay at 0.25%, and we're not really gonna do taper as we expected, right? 2 months ago, I've already said there's not gonna be taper all the way until like late September. If J Powell is super ballsy, is to do that, because when he pulled the taper, or when he take out the taper curtain, that means all of these unemployment benefits are gonna be gone, right? Or it's gonna be like significantly eased. Asset purchasing, the quantitative easing is gonna be not easing anymore. It's gonna be quantitative tightening. That means a lot of people is gonna flood into the job market, and the job market is be overflown. We will quickly transition from a job shortage to a job to a job shortage, or a labor shortage to a job shortage. So that means right now there are more jobs than labor on the market, but later on when they do the tapering, that is going to be more people that want a job but less job available, and that's really bad for the unemployment and for everything that's happening. So what J-Powell is really saying is, all right, policy is going to stay here, but we believe that our long-term monetary goals are sort of achieving, and every these transitory inflation factors due to the COVID is going to ease in the next couple of months. And then sort of like the underlying statement here is, hey, we're still considering taper here, but sort of like under like 4 or 5 layers of curtain here, and all the way until we are sure about the Delta variant, when we are sure about all of the inflation numbers are just being very steady. Basically, what he's trying to say is, in September we're going to look at the October number, and in September we're going to look at the August number, and in October we're going to look at the September number. And October and September number is really important here for a sort of like a interest rate hike, right? But again, we in 2 months, like two months before this video, we already predicted there's not going to be a taper in this month, and we think the economic policy is going to still run the same all the way until late September. And in here, I'm going to predict that in October is when J Money Powell is going to come out and say, hey guys, we look at the data, and here are the things that we're going to change in the near future. And if you really want to sort of like reposition your stock positions, future positions, and all of your other positions, what you're really looking for is the next FOMC meeting, which is on, I think, mid-September. And on that meeting also, it dictates the future of Bitcoin. And around the time when October happens is when we sort of will have a full understanding of when is the very probable date where they're going to increase their interest rate, or they're going to do any sort of monetary changes around that point.
Address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation.
See, this is the part where most people just skipped, or most people just overlooked, because they live in their retail euphoria and they're gonna think, oh my god, like just like before, like nothing's really gonna happen and he's just gonna scare us, blah 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 blah. But what J Money just said is, hey, I personally think. So J Money just say, J Money personally think that, guys, I think the substantial further progress, on inflation is already met, and I think, we are gonna see a taper. This is literally what he's trying to imply here. I think he is trying to. I think at the end of like this year or in the beginning of next year, with the $3.5 trillion budget, the increase in the price ceiling, increase of the budget ceiling, right, the debt ceiling, and the $1 trillion infrastructure bill, the Fed's hands are tied. They have to change something. You either have to taper a little bit, you either have to change some of your monetary policy to sort of combat the future inflation due to the U.S. dollar depreciation or appreciation trade, depending on your perspective, due to all of the budget increase and everything. And you will see a government that will overspend. That I can tell you, the government will overspend in the next, in this run, right? So then the Fed has to address that, because the entire global market is reliant on dollar. The petrodollar, whatever dollar you're saying, right? Dollar is how you measure a lot of the currency in the world, and a lot of currency are pegged to the dollar. And because the government is overspending dollar, there's a huge like butterfly effect in the entire world. Like basically, it's like a ripple effect of, oh, okay, so you decided to over leverage your debt here as a United States government. That means in terms of your credit rating in the world, your currency's credit rating is becoming a little bit shaky. But because everybody else is struggling, they can't really do anything really about how you are shaking over your own credit, and then this is going to become a huge problem in the long term. So for our generation, for millennials, right, this administration's political policy and the financial policy will basically have a long-term effect of how our financial future will be shaped in the next 20 years. So don't be surprised that We might see, the crumbling of the social security system, or the crumbling of a lot of things in America, and the crumbling of, say, a huge correction in the stock market in the next few years. Or like the earliest you will see probably will be the beginning of next year, but I think that's still too soon right now. That the future is still a little bit too foggy right now, especially when everybody's in euphoria. And for a lot of you retail investors, they think that everything's just gonna be fine, and we're just gonna keep going on the meme stock train. But right now, if you look at what Warren Buffett is doing, if you look at what Kathy is doing, if you look at all the big time investors doing, their portfolios are transitioning. Okay, and if you guys want a video that dive deeper into those kind of contents, comment down below, or message us on Patreon, or just engage a discussion in Discord, and when we pick it up, we probably will make a video about that. But if you go look at all of their positions, some very interesting transition is happening.
There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress.
You see here, what he's trying to say is, okay, we do see the progress, and we see a small tapering sort of effort by the end of this year. That's literally what he said. I'm just paraphrasing here, and a lot of people are overlooking at it. That's why, in Patreon Discord, or in Discord in general, I was trying to say that, hey guys, a lot of these retail FOMOs and the euphoria that it formed last Friday might be very short-lived. And you guys know that I make a lot of predictions. This is also the reason why I sort of collapse MMAT, because I think a lot of these like euphorical situation that we put ourselves in is going to be very, very short-lived. I'd rather take my liquidity out and save up the liquidity, and sort of either prepare to short market, or prepare to sort of to prepare for the situation where the market is going to run flat, or trying to position myself in a better position if certain black swan or gray rhino effect happens, right?
In the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks.
Alright, I think this is it for this video, because he literally didn't really talk about anything else important after this. So basically, what you want to understand, or what you have to understand here, is basically the Delta variants or the Lambda variants actually save the stock market for Friday. If there's no Delta variant, if there's no other variant, there's no Delta, Epsilon, whatever variants that's going on, by the time of late September, I think they would actually start tapering. But due to the Delta variant, and due to a lot of Americans are actually hanging on a thread here, because we are literally in an economy where a lot of people are actually very cash scarce right now. You see a very like divergent K-shaped recovery, where poor people get poorer and rich people get richer. And from the pandemic stock boom, rich people get more money and cash to spend, but poor people are losing more and more money. But the thing is, if you take a deep dive on how the K-shaped recovery really work in terms of economic growth, and you sort of stack them down by demographics, you're gonna see a lot of very interesting stuff happening. And you see retail investors' revenue, or retail investor profit from the market, is actually slowly decreasing. But anyways, I think this is it for the video. The takeaway for this video generally is, all right, the Fed is actually a little bit hawkish. It's not really crowish, or just like being back in early 2020 and be like, oh, everything's just gonna be fine. You're just gonna give you more money, more money, right? And a lot of fake news are out there and saying there's gonna be a fourth or fifth stimulus check. I doubt it, and do not believe that. And those are just like inducing a further retail hype, and then this is sort of like helping the institution, the big players, pull their money out. Okay, and just don't fall back into that euphorical state, because you got to be rational here, right? Think about it. What really changed in the past 3 days that justifies this small cap boom? Nothing in valuations, nothing in news, nothing in catalysts, nothing. It's just the Delta variant. So basically, going from, on March 2020, we disbelieve that there's going to be a market downside, to right now, we're over anticipating what people is going to do if there's a market downside. So we're basically sort of like over prepping ourselves for a boom or for a downside here. And we're just trying to do another pump and dump before everybody take a break. But in the general retail, sort of like a retail environment community, everybody is still so bullish. And that bullish sentiment eventually is going to hurt all of your profit, or it will probably hurt your future profit, or all of the profits you already get, right? For those of you who will be like, oh my god, the AM3 train is still going. But is it really though? Think about it, right? If you watch like all of the big time AMC YouTubers, they're just saying you have to buy and hold when it's still $60, right? Or 58 bucks or 55 bucks or whatever. So right now for them, AMC is around 40 bucks. That means at least 20% of their profits are already gone. Just think about it. Even though they're sitting at $6 cost basis, it's still bad, guys. It's still bad. It's still bad trading habit. It's still bad. And if you just keep following them and keep waiting and keep sort of doing your buy and hold and sort of buying into the bullshit where they say, oh, if the market crashes, AMC is gonna squeeze. Good luck with that. Just good luck with that, right? We're not financial advisors. We do not give financial advice. Therefore, everything we say on this channel is for shits and giggles. But a lot of times we feel super bad when people are losing money in the market, because you're just not getting your information from a rational and from a factual based, source or on YouTube, right? And we believe that our channel is one of those leading lights, or the green light there, that give you a factual content, and all our perceptions are based on data and based on factual content. All right, see you guys on the upside. Hope you like this video. If you do, smash a like button. And if you want more and more people to hear the truth and learn about factual economic information, smash a like button. See you guys on the upside.